Hello everyone, this is Roger Scott from Market Geeks with another video tutorial for you today. Before I begin, I'd like to remind you to subscribe to our video channel and don't forget to download your free trading report at marketgeeks.com. Yesterday, I discussed the concept of positive expectancy and how you should always maximize your profits and minimize your risk. I discussed a very important indicator that will help you achieve this goal. Today, I'm going to teach you how to use the average true range ATR indicator to measure stop loss placements as well as profit targets. I discussed the ATR previously in past articles, but I want to show you real demonstrations so that you can get a feel and get more comfortable incorporating this indicator into your trading plan. The ATR was developed by J. Wells Wilder to measure the volatility of price changes, initially for the commodities market, and later adapted to the stock market as volatility in stocks rose substantially in the last 40 years. The ATR is not an entry or exit indicator, so it's not as popular as some other indicators such as the moving average or the stochastics indicator. However, the ATR is one powerful indicator, and if used correctly, can increase your profits and help you minimize risk at the same time. The ATR was originally designed for daily charts, but since volatility has picked up so much over the last several decades, the indicator can be used just as effectively for intraday chart analysis. Contrary to several technical indicators, the ATR is extremely easy to calculate and just as easy to use. The ATR simply calculates the maximum values of the following three differences: between the previous day's high and low prices, between the previous day's close price and the current day's high price, between the previous day's close price and the current day's low price. The ATR is built into most technical analysis software platforms, so you don't have to manually calculate anything yourself. When used for day trading, the formula simply changes the time frame from daily to intraday, and the formula will take care of the rest. The only change I make is I average the last 10 days or trading bars, while the original formula averaged the ATR for 14 days or bars. I find that the shorter time frame makes the ATR react quicker to dynamic changes in volatility that occur in today's markets. Let me show you a few examples how the ATR measures volatility so that you can see how I use this indicator in real time. In this example, you can see the E-mini S&P futures contract. I specifically wanted you to see this example because you can see how the index starts off with relatively low volatility and consistent trading range. And in the latter part of the example, you can see how the volatility picks up and the ATR increases simultaneously with the increase in volatility. If you were trading the E-mini S&P futures contract and you used a tight stop loss order in January of this year, you would probably do well. But if you used the same type of stop loss order in April of this year, you would be stopped out before giving your trade the opportunity to work in your direction. Similarly, notice this chart of GLD, which is an ETF designed to track the gold market. This 15-minute chart demonstrates how the average trading range jumps from 20 cents to over 50 cents in one trading day. Many traders use the trading range to determine their stop loss placement. Imagine if your stop loss level was based on 20-cent range when the market is trading at a 50-cent range. What's great about the ATR is that the numbers that are produced are based on actual dollar values of the market you're trading. Imagine you're trading using an indicator like the RSI that gives you an overbought or oversold level. The ATR actually uses dollar values so you can easily make modifications to your stop loss and profit target levels based on the actual dollar changes you're seeing. In this example, you can see how I adjust my stop loss level based on the volatility and, more importantly, the ATR average reading that I'm monitoring in real time. Notice how the stop loss moves dynamically as volatility increases. Thank God for electronic trading. Imagine having to call the broker each time I make a stop loss change. Now that you understand how the ATR is calculated and dynamically changes based on the actual volatility, it's time to see how to place actual orders. What I typically do is multiply the ATR level by 2 and subtract that from my entry price if I'm going long. If I'm going short, I multiply the current ATR times 2 and I add it to my entry price. Once there's a 20% increase or decrease in volatility, I go through this process all over again. I keep doing this as often as I have to. Profit targets are calculated similarly. I take the current ATR and multiply it by 4 and add it to my entry price. If I'm going short, I will subtract 4 times ATR from my entry price. The ATR is the best way to measure volatility of your current position. It can be used with daily or intraday charts effectively. The only change you need to make is to adjust it using 10 bars instead of 14 to make it a bit more dynamic. The ATR is very dynamic, so don't be afraid to make adjustments to your order as often as necessary. Don't forget to subtract the ATR from your entry when you're going long for stops and to add it to your entry when you're using it for profit targets. Reverse this for your short positions and you should do just fine. Thanks for joining us for today's tutorial. Don't forget to subscribe to our video channel and visit marketgeeks.com for your free trading report. This is Roger Scott wishing you the best in your trading.